now we are managing to recover from the day's lows, but we are still below the 24,400 mark. We are managing to recover, but we haven't managed to cover up those gaps. Nifty Bank still reeling under selling pressure. But let's get on board Aniruddha Naha, who's the CIO of Alternates PGIM India Asset Management, joining us now to weigh in on the markets. Hi Aniruddha, thank you so much for joining us today.
Thank you.
Another, after the rally that we saw in the markets, in the last few weeks, we are up almost 10% in the last 1 month. We're seeing a bit of a breather coming in the markets now. There's some news coming in on the tariff front, also specifically on the pharma front, and the way the geopolitical tension is playing out. Do you see a bit of a caution in the air right now? Is this not the time to throw caution in the air and be a little more conservative right now?
So thank you for having me here. See, generally what we do track is data against sentiment. Data, frankly speaking, the way we look at it is actually turning reasonably positive, both at a macro and then at company and micro levels also. So if you think of it, we remain reasonably positive, but for the geopolitical tensions that are going to play out, see, this is something we will not be able to model, and hence it's a binary event. But if you look at data points, frankly speaking, earnings have started picking up. Rate cuts have happened in India. The currency is actually strengthened. The RBI has put in a lot of liquidity. So, from a macro perspective, I think lots of things have changed for the positive. Stocks earnings have started turning positive. The only thing that has changed negative, and that is primarily driven by sentiments, is the human emotions that are involved. Last year they were extremely positive. This year we are extremely reasonably conservative. We usually like such scenarios where data is positive and sentiments are cautious or negative. It's a great time to go ahead and build portfolios.
All right, totally take your point. Hi, Aniruddha. Good afternoon.
Right.
This is Shrishti also joining in. But Aniruddha, where do you sense the margin of safety in this volatile times? Because yes, the markets are giving moves both ways. It's been a lot of volatility that we are witnessing, at least for the past 4 to 5 months. But which are the sectors that are looking attractive to you?
Clearly, something like pharma is something that we remain positive on, in spite of the news around tariffs coming through. Our belief is even if the tariffs come through, it will not be disruptive, and a large part of it will be probably borne by the insurance companies in the US rather than pharma companies sitting out in India. The financialization of the economy, including banks, to that extent could probably be an interesting place to hide in. And chemicals and agrochemicals, they have not participated too much, but the earnings bottom of the cycle seems to be getting in place. So that could probably be another interesting place to be in.
Right. Also, Anirudh, talk to us about the consumption theme, because we've been talking about the consumption picking up now with the rate cuts coming through, and the liquidity infusion by the RBI. How do you see the consumption space, and which part of consumption do you see value in? The discretionary end, discretionary end is something that the analysts are betting on, and within that, what are the pockets of value for you?
Sure. So we believe discretionary consumption is a reasonably long-term trend in India, and will follow basically your per capita GDP increases which happen over a period of time. In the near term, the pockets, frankly, there are a lot of pockets which look interesting over a longer period of time. Near term, I think valuations and the slowdown that we have seen, a little bit of a slowdown that we have seen in the last 6 9 months, have made us very choosy about what we go ahead and buy out there. So something like buying into music is something that we believe low ticket discretionary item, very interesting space to be in. Liquor is something that we believe, though it is termed as staples, but that's another space where we believe there is reasonable amount of growth opportunities. Where we would be a little cautious is travel and tourism, because I think that space has played out phenomenally well over the last couple of years, at least post COVID. Their valuations are a little stretched, but again, with a longer term view, we believe that travel, tourism, hotels, etc., would be very interesting. It's just that we would want to wait for the right valuations to go ahead and build a position out there.
All right, Aniruddha, but I just wanted to touch upon chemicals because you did highlight that that is one of the sectors that is looking attractive to you. But Aniruddha, what I sense is that this is one of those global linked sectors because for now there's a lot of uncertainty that is building in, be it from the cap group companies to the auto global OEMs. They are taking back their guidance. They are looking forward to some uncertain times, and amidst that, in no matter and no time, we will start getting to hear from those chemical majors. What is making you bullish for the chemical plays right now? And within that, will you go for specialty chemicals or base chemical companies? Where is that you're looking in opportunity?
Sure. So we are positive, getting reasonably positive on chemicals and more so on agrochemicals. If you look at it, both these sectors have gone through a reasonable down cycle over the last 2 to 3 years. In fact, agrochemicals has gone through a longer down cycle. The good thing about this sector is large part of the capex is over. Numbers are already reflecting the depreciation hit, etc., interest cost hits, etc. Now, the reason why we believe this could be a turnaround sector is the inventory channel checks clearly show that the inventory levels have started coming back to normalcy. If that is the case, I think so slow amount, even if not large amount of pricing power comes back, but there would be some stability and downside protection in terms of where the pricing would entail, and hence margins can start becoming more predictive in nature. But to align with your thoughts, the only caution that we would be, or something that we would be looking at very closely, is what is China's policy, and if they continue to dump at below manufacturing costs, which we think has slowed down, where even to that extent the dumping from Chinese have come off. But if that restarts, then I think so chemicals per se could see some amount of pressure again going ahead. But our belief is the worst is in place. Agrochemicals is a little more domestic oriented. The monsoons are predicted to be good. Last couple of monsoons have been good. The water tables are good. Earnings in rural India have started doing well. So we believe that's a segment where at the bottom of a cycle things can start coming back.
Right, Anirudh, you also mentioned that there could be some positive surprises as far as the earnings are concerned in the SMIDs. Most, up until now we've been talking about the large caps, but speaking of the SMIDs, even though the valuations are a bit stretched, there are pockets of value within that as well. So what are these areas of pocket, and what are these earning surprises? Where can we expect this?
So just let me clarify a little bit. I think the mid cap segment continues to be a little expensive. There is no two ways about it. But once you go down the curve to the small caps and the micro caps, I think there are a lot of stocks where numbers are good. What is interesting is today the small and micro cap segment has a balance sheet which is cleaner than the large and mid cap in terms of debt to equity. So the resilience is extremely high in the small and micro cap side. That is one. And this has not happened in the last, let's say, 20 odd years from that perspective, the cleanliness of balance sheet. Then when you come down to, frankly, small and micro caps, it becomes very, very company specific. But to give you a sense, the capital good companies which have declared results in this quarter till now have actually surprised a lot of people, frankly speaking. Chemical companies in the small and micro cap have surprised people, and that is reflective in the kind of stock price movements that are happening in some of these names, irrespective of where the overall markets are going. So our sense is it's a great time to be a bottom up stock picking team. Go ahead and build look for businesses where earning stability and some amount of pricing and operating leverage can lead to reasonable amount of earnings growth coming through. Very difficult to pick a sector, but at a stock specific level, I think so there are a lot of places where money can be made.
Appreciate the fact, Aniruddha, that you are coming on air and sharing your positive take on the small and micro caps because they have an earnings potential surprise. That's a different flavor that you're getting for our viewers. But Aniruddha, banking is another theme that you're tracking. So within banking, would you suggest to take your eyes off the large cap names which have already delivered fantastic returns, at least in the recent while as well, and maybe it's time to niggle into some of those small banking names?
So we've largely stuck, like the industry, we've largely stuck to probably the top three or four names because at least it lends visibility. The fear of going down the market cap in financials is financials happen to be one of the most leveraged businesses because they for 100 rupee equity or capital, they go ahead and borrow about 600-700 rupees of deposits. So one needs to be extremely careful about going down the market cap. Having said that, there are some very interesting names in the small cap space, even in the mid cap space, where one can nibble depending on what is the kind of appetite one would have in terms of volatility or the risk appetite there. Largely, probably can we shift about 5-10% out of large caps or 20%? That could happen, but even today, we believe from a stability perspective, we would stick to the larger names in the banking sector.
All right, sticking to the larger names and in the banking sector. On that note, Aniruddha, thank you so much for joining us, taking the time out and weighing in on the markets and your picks. Thank you so much. But with that, it's time for a quick breather. Don't go anywhere.
If you like this video, then like, share and subscribe to ET Now.